The conversations continue here in Davos 2025, and back with us in the CNBC-TV18 studio is Moynihan of Bank of America. Bhan, it's great to have you back here on CNBC-TV18, and congratulations on completing 15 years as CEO.
Well, thank you, and I remember our interview way back in India was one of the earlier ones, so we've both been at this a long time.
Yes, we have, but let's talk about Trump and what that could potentially mean for the banking sector, the hope of deregulation, and that's certainly what the banking sector is hoping for. But I just finished a conversation with Kenneth Rogoff, the economist, and he believes that any excessive deregulation, especially as far as the financial sector is concerned, will perhaps be Trump's undoing. How do you see the need for deregulation as well as the need to balance deregulation?
So we believe, my peers, ourselves, we all believe in having a very safe and sound, well-capitalized, liquid banking industry. And there's two reasons for that. One was that's good for America and helps it grow, good for the world, helps it grow, supports growth around the world. And it's one of America's best industries. So who would want an industry that had any other characteristics? The second reason, it's more technical. Within the United States, when banks fail, we pay for it. So we have a higher interest than regulators who come and go, and the politicians who come and go. We end up paying for it. So last year, we took $2.18 billion over 2 quarters in charges due to the failures of the regional banks. So we want them run well. And so when you think about it more broadly, we've had a problem that the pendulum swung too far, and we want to bring it back. And the extra capital demands, it was quiet, but what happened is we kept increasing capital. So from 2019 to now, with a company having no more risk in it, no more loan balances, no more trading assets or wholly different anything, our capital requirements went up 25 or 30% by the creep in the system of all the calculations. And what we're saying is we got to go back. If we're well capitalized by Ben Bernanke, Janet Yellen, and Jay Powell's statements over the years, and we were well capitalized at that level, why do we need more capital to get the same capital ratio? It's not what people say, well, your capital ratio there was 11.2 and 11.9 and now it's 11.9. It's the underlying calculation is what drives it. So $30 billion more capital basically means the same capital ratio.
So that's the key ask there in terms of capital requirement from a deregulation perspective? That's
one. I mean, there is capital, and then thinking about the liquidity rules and how you support the market. The pandemic hits, instantaneously we take on $70 billion of loans. We provide tremendous liquidity to the capital markets. The way they've changed some of the liquidity rules, you can't do that because you can't hold the amount of treasuries. You can't, because they start on the requirements that require you to hold high liquid assets or supplemental leverage ratio, you end up not being able to hold treasuries or mortgage backs, which are government guaranteed and support the market. So again, we're trying to get them to put it back in balance. It was there before it moved away from us. And so, those are the types of things. And on the consumer side, it got to be regulation by rule or not regulation by rule, actual lawmaking by rule and extending laws that were not intended. And we have 100 senators and 435 Congress people and 300 million American people who put them there to make decisions, and regulators shouldn't make them. So all that will come through. And our job in the industry is to get it where it should be. It's fair to the consumer, fair to the company, helps drive American growth, helps drive worldwide growth, and focus on it.
Well, let's focus on growth then. What's the expectation in terms of growth in 2025 with the tariffs, the threat of tariffs playing out the way that President Trump has said it would? What would that mean potentially for inflation, and what will it mean as far as interest rates are concerned? Do you expect a rate cut in 2025?
So I think we'll find out here in the next few days. There's supposed to be a lot of executive orders and a lot of clarity ought to come out of the administration as they take office today. And so we'll find out what it all means. But based on the discussions up until now, our research team, which is which is the best research team in the world, and Candace Browning-Platt and the team do a great job, basically had that if tariffs were 10, 15%, they would be offset by efficiencies, productivity, margin improvement, and then the price would the value would get passed back through the consumer, because America's a big competitive market, so it would go back to them. And so they were not unnerved by that. So even given some of that, they believe the U.S. grows at mid-2s, 2.4, 2.5 next for 25. And then they believe the Fed is done cutting rates. That's a little more, whatever the conservative, whatever the right word would be. They believe the Fed is done cutting rates. The market believes the Fed will cut the rates. When we look at the consumer information we have, the consumer's pretty healthy. They have a lot of money in their bank accounts. They're earning money. The unemployment levels are low. Their credit quality is good. And they're spending at about a 4.5% clip, our Bank of America customers, comparing the first part of January to last year. But it's kind of, in a place where you'd expect 2% growth in the economy, 2% inflation. It's where it was in 17, 18, 19 when the Fed had raised rates. So it's a good normal place, and I think that's where the Fed has to be careful, because in small business and middle market companies, the interest rate pass-through is much more severe. So, meaning if I borrowed at 250 basis points over SOFR, when SOFR was 25 basis points, and now it's 450 basis points, that's a big difference in borrowing cost. And so that slowed down those customers, and we'll have to see the Fed watch that, because they are the employers, and if they slow down, they don't hire. And so right now everything's good. There's some enthusiasm with the new administration. We'll see if that plays out. But the Fed's got to monitor the downside as much as the upside, meaning the downside, the economy slowing down faster than they think.
You talked about the resilience that we have continued to see for the American economy, and consumer sentiment has stayed strong through 2024. What's the indication as we head into 2025?
Our team has always thought, and our data showed, that the U.S. consumer is in much better condition. You would have had people last year at this time or the year before say, oh my gosh, they spent all their money, there's going to be mass. None of it happened. And it wasn't, and by the way, if you looked at the customers we have, which is not a small sample, we have 40 million checking customers, you could see the money moving in and out. We've tracked the data for 30 years. They weren't depleting their accounts. The people who had money with their accounts prior to the pandemic had multiples of it before. The very high end, when rates went up, of course they moved the money into the money market funds and other places. So we didn't see that. The credit quality didn't normalize in 2019, which was a very good year for our company and the industry. So a lot of this was just coming off of very low numbers up and then flattening out, and we've seen that. Now we've made it through that. So I think the idea of the risk, the downside, and the risk to the consumer is really if they aren't employed, and this is a U.S.-centric discussion, and that's going to come down to how businesses feel. We, basically have 213,000 people. We hired about 1,300 people a month to stay even with that head count. We kind of manage it down over time, but it's not like we're laying off people and changing our head count. And the productivity comes through, but if you manage ahead of it, and most companies can, it's a slow movement through society.
Well, as you pointed out, it's been a good year for Bank of America. What's the outlook now in terms of net interest margins? Do you expect them to be higher? Loan growth, what's the expectation for the year ahead?
So if we just had our earnings last week, nearly $7 billion, 82 cents, et cetera, et cetera. The third consecutive quarter of moving north in net interest income, which is our spread business, loans and deposits. Deposits growing, loans growing better than the industry. So we feel very good about that. What we told them is we would move up again in the first quarter, just a little bit, because there's 2 less days, and that doesn't mean a lot to a lot of people. It's $250 million on a base of 14, so it's meaningful. And then we said we'd exit the year end about $15.5 billion. So that's a pretty strong growth rate. It'll be a record year for NII, given all the conditions that we see today. It'll be a record year, and the number should grow 5, 6, 7%, which is very strong.
Well, let's talk about India, because this is going to be your 80th year for Bank of America, and India is a significant milestone. How's India looking to you at this point in time, and specifically from a Bank of America point of view, what's the plan?
Well, there's if you think about India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy and keeps moving north. All the programs of Prime Minister Modi and the governments over the years have been working. It's becoming hugely digital, 800 million phones, and all the stuff we talk about. And you see the digital impacts with our clients and our customers. Our business there is really 2 things. One is a corporate investment bank and a trading in underwriting and debt advice, and et cetera, and then in corporate lending and treasury services. And the second business is we have a big back office for the world out there, and about 20-some thousand teammates. And we've had that for a long, long time. And so that business, it's great. It shows the world that you can continue to develop. What that business was 30 years ago, probably when I first became familiar with it, to now is much different, and much different types of people, and huge campuses with schools and everything we do. So that's a good thing, and it will be a great backbone. But I think other people see that opportunity, which is the talent in India, the education, the ability to get lots of engineers quickly, and those things is great. When you go to the core business, we are very enthusiastic about India. We expect the economy to grow. We expect our business to grow with it. Kaku and the team do a great job, and we just expect that to continue. Interesting, the one in the middle is we've invested a lot in the treasury services for the real-time payments and things. And I think this is an area that we all got to be careful around the world, is we're dividing up the data about customers into little tiny pieces, and that's not efficient for multinationals. So I think one of the things that we try to talk to the European regulators, or the Indian regulators, or Brazilian regulators, is this idea of taking information for multinational companies and trying to putting little boxes.
Data localization norms,
is cost you a lot, and is it really going to provide a great service? Do you want those flows of capital? You want that multinational to be able to move money in to support growth and then move it back out when it needs it somewhere else, because that makes it a better proposition for the multi. If it's money that goes in and gets stuck or data gets stuck, so we're trying to help to get that balance right. But it's a great business. We expect to grow.
Well, speaking about moving money in and moving money out, what do you expect in terms of fund flows into markets like India on the back of what we're seeing happen in the U.S. with the dollar strength?
Well, I think the fund flows in India ought to be among the strongest around the world because it's sheer opportunity. And so, manufacturing as a major extra source, the services economy, which is strong. And by the way, it's building a huge internal economy. And that's one of the tricks for an economy to really get big and sustain is to have that internalization of the economy, that consumption-based economy. And as the GDP per capita keeps moving up and the people have borrowed a little bit more money to buy cars and things that are more capital intensive, but that's all going, and that's good stuff. So I think we believe the country has good prospects. Therefore, money will flow towards it, because what people want to invest in is where they can see growth, where they can see profit, where they can see opportunity, and that's your country is one of the places that people see it around the world.
Well, and the Indian stock markets had a pretty strong year, just like public markets the world over, including the U.S., but the IPO market in specific had a stellar run in India. What's the expectation as far as public market performance is concerned in 2025?
So let me go back one thing more generally. One of the things that your country's been doing that's very strong is developing a source of energy which doesn't submit it to the world's energy prices through all the sustainable energy they've done, wind, solar, et cetera, hydro, and all that is extremely important because in the end of the day, the biggest risk for most countries are oil price volatility. We saw it over the last year, and inability to get supply when you need it to support these wonderful manufacturers, and the environmental piece is the other major issue. Yeah. So your country's done a good job of creating energy security through renewables, and that's one of the things that gets lost in some of the discussion is the only way, what makes America interesting is they have energy security. We can produce our own energy. Now, we don't necessarily produce exactly what we consume, but we produce more than we consume, and we could flip it internal if we needed to and create an internal market. But for countries that don't have the core resource, you have to have power, whether it's nuclear, whether it's things to drive it to be energy independent. So that's something your country's done that's very good because it puts on a course to be less susceptible to importing inflation from gas price spikes or oil price spikes, which is important. The IPO market, there are 100,000 startups, I think, in India. There's 1,000 of them that are getting towards, big enough and interesting enough for the public markets. 100 of them, I think, are unicorns or something like that. Those statistics. Therefore, the markets will receive them. But I think the key is that with all the markets now, if you're, as we see across the world, if it's biotech or something that's really different, AI, that's different. But if you're a core business, you got to have a path to profitability because the markets won't support without seeing that profitability. So you either got to have pretty good cash flow and profit before you go public, or got to have a very, very understandable task, because you're competing against companies which make a lot of money and are making money. And at the end of the day, your valuation is ultimately going to reflect your ability to earn money and grow it in the future.
But let's talk about the transformational impact as well as the disruptive impact. What are you seeing within the business? What's the take on agentic AI, which seems to be the buzzword here? How are you incorporating that into your business? Well,
so we think about AI across multiple dimensions, and we've been at it for a long time. So we have a virtual assistant and have had it for a long time called Erica. It has 20 million people use it every day. And now we've taken that technology, which was in a parlance of today, but nobody would have called it that back then. 10 years ago, we built the models with some people. It's a natural language processing model, but it'd be a small language model. In other words, more tailored to financial services, more relevant with our understandings in it and our training in it. That now has been used for our technology support for our teammates. So about half the calls that would have gone to a human being to interface with a teammate to change a password, order a piece of equipment, all now go to, all handled by the agent, the bot, so to speak. And then we put it into our Cash Pro, to our institutional payments, and it's used heavily. Then we put it into our ability to do credit offering memorandums and the things. So we're seeing that technology go through. So we think this is very provable. In the coding space, we get in about 10 to 15%. We got 1,000, 1,500 coders using it today, and we're picking that number up as we train them on how to use it. They still have to check it. We still have to have a human between it and deployment, because you can't sit there and say, oh, the model made me do it. What's going to happen? So we keep doing it. We think it has high possibilities, but in a financial services regulated, in a business which holds a the experience of 60 million consumers and hundreds of thousands of millions of businesses in its hands every day, you have to make sure it really, really works. And that's our experience over the last several years. So, yes, customer help. Yes, employee efficiency. Yes, how you deploy the Salesforce, what Salesforce has in coming. We're one of the big users. We get advantage of that. Yes, in terms of any place a lot of data has to move in finance or risk and get thought through and put there in analyst investment banking. Yes, coding. Yes, and we'll just keep working at it.
Cryptocurrencies, and that has been the big bet for President Trump. I mean, he's been vocal about it, and we're waiting to see what actions the regime will finally take on cryptocurrency. I don't know if you've seen what's happened to the meme coin overnight, the Trump meme coin, but, do you believe that this is going to be an inflection moment now as how the banking industry looks at cryptocurrencies?
Well, there was always this goes back to the regulatory confusion and all this stuff. So not only in our country, but around the world, there's always been this sort of, we're letting it go on, but you can't do it because we don't think you should, because it's so. In the end of the day, banks send all their money digitally today of any consequence. In terms of dollar volume, it's way over that. It's 99%. So $3 trillion will go out of Bank of America in the next 24 hours digitally. So it's not like an idea of sending money digitally in digital form transfers as anything at all. So if you think about that, we also believe in a blockchain. We have hundreds of patents. We're still trying to figure out how to work. So we got that. So the real question is, if it's a stable coin type of, dollar backed, it's like a money market fund, 100%, can't break the buck and all those things. And we know where those assets are, and we can drive those assets, and our consumers actually want to use it. We think there's value there. And at some point, if it becomes okayed by the regulators so that you can actually do it, and it's okayed in terms of who's holding the money, and we do it, and okayed in terms of the attribution of who's moving the money because of the BSA/AML rules, then we can engage in it heavily. And you'll see bank coins and all this stuff for the commerce part of it, for the actual payment part of it. The investment part, I'll let better experts talk to you about that, because in the end of the day, the money can move infinitely. Today, digitally, this will be another form. So if somebody, instead of using a credit card and somewhere up in the mountains here in Switzerland, they can pay by a stable coin, so be it. That's just another way money moves.
So if the regulatory clarity emerges, are you ready to?
We've been studying it for years. It's not clear what you can do, and we can't do it through people who can't have the attribution to the customer level we have to have. We have to know, we have to know our customer's customer, and that's a difficult thing. So what we did to help in the banking industry, a different type of form of payment in the U.S. was Zelle. So we said we'll form one thing that the network of payees and payors are all bank customers, so we can rely on PNC or JP Morgan or Citi's having done the work with that customer, with money around. And so I think there'll be ideas like that form as time goes on.
So let me end by asking you, Brian, 15 years, you've seen the bank through many difficult periods, the 2008 financial crisis, COVID, of course, the more recent one. What's been the big learning or the big learnings over the last 15 years of steering a large global corporation through difficult times and emerging stronger?
Well, the team does a great job, and you have to have a great team. That's number one. Number two, we have to, the organic growth engine, which has been really kicking in for 10 years now, continues to take market share in every business, whether it's doing tomorrow in a trading business, taking more share, whether it's investment banking moving from the 5th position to the 3rd position, whether it's in the consumer business moving our share. So the idea is we just have to continue to generate, whether it's building up our international platform. When the team took over in 2010, we had about 20 billion in loans outside the United States. Now we have 100 billion. So we've grown nicely. So the idea is that organic growth engine. So the trick was, in the early days, was to keep people focused on the organic growth where you cleaned up the thing. That hasn't been, there's no work needed there for a long time. So now it's how do you keep people driving the organic growth? We earn more money than very few companies that you're going to talk to here at all. I'm not talking about banks or non-banks, and we do it the right way. We do it great for our customers. So the principle are have a good team, drive towards the organic growth. You have to watch the risk because you have to be there for your clients in tough times, the pandemic, the drop in rates, the rate structure movement. And then at the last part of it, you have to have a team that really likes working for your company. We've worked hard on the benefits and the pay and everything we do for our company so that we have the highest employee satisfaction we've ever had.
I heard you say that you're just getting started.
Well, there's a lot ahead. This company has great prospects, and we're all excited for it.
Brian, many, many thanks for joining us. We look forward to seeing you in India in 2025, and we hope we can catch you there as well. But appreciate you joining us here in Davos.
We'll absolutely do that. Good.
Well, we will take a break here, and the conversations continue. Don't go anywhere. We're back in a moment with more.